we are looking at a really strange divergence in the crypto markets this week.
Yeah, they really are.
You've got prices just, flatlining.
Yeah.
Bitcoin is stuck in this consolidation, this holding pattern between, what, $87,000 and $91,000?
Mm-hmm. A wait-and-see mood?
But then if you look under the hood at the regulation, at the tech, it feels like the actual plumbing of the financial system is being ripped out and replaced.
It really is a split-screen moment. I think that's the best way to describe it.
Yeah.
While everyone is staring at that sideways price action, waiting for some kind of breakout, the fundamental story is just shifting so aggressively towards safety and infrastructure.
And speaking of safety, I saw a stat in our research that, honestly, it made me do a bubble take. We always compare Bitcoin to gold, right?
Right, a classic matchup.
But the new data is pointing to a massive showdown between gold and Ethereum.
That's the silent killer in the data right now. I mean, gold just hit $5,000, which is a headline on its own.
Sure is.
But the real story, the one people are missing, is that gold has actually outperformed Ethereum over the last 5 years.
Wow. That feels like that's a punch in the gut for the whole ultrasound money narrative around ETH.
It creates a massive identity crisis, a huge one. If Ethereum isn't digital oil for a booming economy, and it's losing the store of value race to gold, what is it?
Good question.
Right now, you see investors fleeing to gold, and it signals they just want safety. And since the crypto market can't offer that stability through price, governments are stepping in to manufacture it.
Which brings us right to the Genius Act. Here in the U.S., I've seen the headlines, but can you explain why this specific act is getting so much hype?
Well, it sounds incredibly boring, and honestly, that's the point. The Genius Act essentially mandates that stablecoin issuers hold one-to-one reserves.
In liquid assets, right.
In liquid assets. So for every digital dollar, there's a real boring U.S. dollar or treasury bill just sitting in a vault somewhere.
So no more fractional reserve magic, no more trust me bro accounting.
Exactly. It's the ultimate green light for conservative capital. Pension funds, insurance giants, they can't touch magic internet money.
But they can touch a regulated digital dollar backed by U.S. debt.
That's it. And it's not just the U.S. either. The UK's FCA just finished their crypto rulebook, and Japan is moving to legalize crypto ETFs.
Japan really seems like they are trying to make a serious comeback for that liquidity crown.
They are. It's a play for clean liquidity.
Yeah.
They want the institutional money that is, frankly, terrified of unregulated offshore exchanges.
And that institutional money is already parking itself on chain. I mean, we have to talk about BlackRock.
Of course.
Their BUIDL fund, which is basically a tokenized money market fund, just smashed through $1.5 billion in assets.
And the key there isn't just the number. It's that trading desks are now using that fund as collateral.
Right.
That is the convergence we are always talking about. You saw it at WAGMI Miami this week, 40,000 attendees, and you had Goldman Sachs suits standing right next to the hoodie-wearing developers.
It is wild to think of banks sponsoring the event that's supposedly building the tech to, replace them.
It's a strange world.
But, okay, we can't ignore the messy side of this. It's not all upgrades and handshakes. We had a pretty nasty exploit on the cross-curve bridge.
Roughly $3 million lost. And this brings us right back to that risk-reward tension. This was a spoofing attack.
Okay, for those of us who aren't hackers, what does spoofing actually mean in this context?
So imagine someone calling your bank, pretending to be you, but using a voice changer that is so perfect, the bank authorizes a transfer.
Oof. Okay.
The attackers basically tricked the bridge into thinking a transaction had happened on one chain, so it released the funds on the other. It just reminds us that while the institutions are here, the digital bridges we drive the money across are still fragile.
That is terrifying. But on the flip side, we have networks trying to engineer that risk out of the system. Solana is pushing this Alpenglow upgrade.
Right. And Alpenglow is huge because it targets what's known as MEV spam.
Okay, let's pause. MEV spam. Break that down for us.
So MEV stands for a maximum extractable value. Basically, you have these robotic trading bots that just flood the network with thousands of junk transactions to try and cut in line and front-run your trade.
To make a tiny profit.
To make a tiny profit. It clogs the network. It slows everything down for everyone.
So it's like thousands of people cutting in line at the grocery store all at once.
That's a perfect analogy. And Alpenglow is the filter designed to stop that clogging. It also aims to cut transaction finality, the time until a trade is irreversible, down to 150 milliseconds.
Wow.
The whole industry is realizing that speed and security, they aren't just features anymore, they are the entire product.
So we're moving from, what, a casino to a high-speed fortress?
That is the hope. The infrastructure is being totally rebuilt. The Genius Act, the FCA's new rulebook, it's all turning crypto from a speculative frontier into a regulated asset class.
But like we saw with Crosscurve, the technical risks are still very, very real. In 2026, security isn't a feature. It's everything.
The tools are getting better, but the vigilance just has to remain high.
So here is a thought to leave you with. If stablecoins, thanks to things like the Genius Act, actually become safer than traditional bank deposits, do we start to see a capital flight out of traditional banks and into crypto purely for safety?
That is a trillion-dollar question.